Well, as 2008 comes to a close in mere days, but that might not be fast enough for some investors. As we get ready to say goodbye and good riddance to 2008 stock markets, we take a look back in history to see what's ahead for 2009. And our next guest, you're getting all choked up about it. I mean, it's an emotional time for all of us.
It was an emotional win, and we're all very excited about putting 2008 behind us and kicking it to the curb once and for all, and that's no doubt about it. We're happy about that. But what's interesting is if you look at the combination of a Democratic president with a Democratic administration behind it, the last time we had that was in the first 2 years of Bill Clinton. And so if you look at the S&P during those first 2 years, it's pretty interesting that the market was up only about 3% per year during those first 2 years. So we're looking at where the market is and where it's going. Bill Clinton kind of has a similar kind of formula to what Barack Obama is going to step into in January. But so how does that compare to 1994 when that switched for Clinton and we had a Republican Congress instead? That's right. And so what happens is, it's interesting because Clinton has this following that he's wonderful for the markets, but in the years where he had the Democratic Congress behind him, it wasn't so much the case. It was only a total return of 7%. The following 2 years after they threw out that Congress, the market was up over 30% per year the following 2 years.
So then how does an investor now, getting ready for 2009 and that formula of a Democrat in the presidency and also Democratic Congress, how do you start positioning your portfolio? You mentioned the markets went up, not as much as they did with the Republican Congress, but they still went up in that situation. So how do you get your portfolio ready?
Well, what you have to look at is you have to say that basically we're in this big trading range, and I don't think that we're going to break out to the positive. So that's okay. If you know that we're in a bull market of volatility and we're just going to have a lot of extreme up and down, but no real breakout to the positive, as long as we're not breaking out to the negative, most people would be happy with that. But how you make money in that kind of sideways volatile market is you can't just buy and hold the S&P 500 index. You're going to make no money. In fact, you haven't made money in that index in about 10 years. So if there isn't going to be any room there to make money in the next couple of years, you have to look to those other strategies. You have to maybe leave some of the bonds. When you look at asset allocation, everyone's asset allocation got out of whack because the S&P and all of the equities are down so much, and their bonds, if they had some, are a bigger piece of the pie. Normally, you'd reshift back and buy some more equities, and I don't know that that's the right thing you want to do right now, full steam ahead.
So do you stay a lot? I mean, do you weight your portfolio more heavy on the bond side? I mean, do you stay in cash? What about commodities? How do you shift those around?
You need to have a good portion of your money in those alternate strategies. It could be commodities, it could be market neutral strategies. And market neutral strategies are a great way to take advantage of it because they take advantage of the up and down without really breaking up to the bottom.
When I hear market neutral, I think that's like an oxymoron these days. I mean, is there such thing as a market neutral strategy, Doug?
Yeah, if in a market neutral fund, what they'll do is if they want to take out the risk of the market and basically give you equity-like returns with fixed income volatility, what they'll do is they might go long Walmart and go short Target. So you effectively take out that retail sector of the market and you take advantage of an increasing demand on one area.
But again, leave it to the professionals for that sort of strategy. Professionals like yourself, for example. Doug, thank you very much. Appreciate that insight. Well,